Hey everyone, quick heads up. This video covers all the key market updates from October 15th. Even though it's yesterday's news, the insights and the trends are still super relevant for today and the days ahead. Watch till the end and stay tuned. I'll be uploading October 16th financial updates this evening. Enjoy the video. October 15th, 2025 wasn't just another trading day. Something big happened in global finance that could change everything for Indian markets in coming months. While headlines talked about a simple market bounce, the real story is much deeper. Today I'm breaking down that what actually happened, why it matters for your money, and what to expect next. Before we start, a quick update on what happened in numbers. Indian stock markets roared back today. Sensex jumped 575 points to close at 82,605. Nifty gained 178 points to reach 25,324, hitting a 1-month high. But here's the thing, these numbers only tell part of the story. To understand what really happened, we need to look at what's happening globally. So let's break it down step by step. Section first, the Fed's big signal. What did the US Federal Reserve say? Yesterday, Jerome Powell, who is chairman of the US Federal Reserve, basically America's central bank, gave a speech, and what he said changed everything. Powell hinted that the Fed will cut interest rates not once but possibly twice more this year, in October and December. He also said something even more important. The Fed might stop something called quantitative tightening very soon. Now, what is quantitative tightening? Let me explain quickly. When central banks want to control inflation, they reduce the money supply in the economy. They do this by selling bonds and pulling money out of the system. This is called quantitative tightening, or QT for short. It's like draining water from a pool, but now Powell is saying they might stop draining that water. In fact, they might start adding water back by cutting rates. This is huge. What is the effect of this? When the Fed cuts rates and stops tightening, it means more money flows into the global financial system. This money needs somewhere to go, and historically, when US interest rates fall, money flows out of America and into emerging markets like India, China, and other Asian countries. So today global markets celebrated this news. US Treasury yields, which are basically the interest rates on US government's bond, fell to 4.02%. When Treasury yields fall, it means investors expect lower rates ahead. This is good news for stock markets around the world. Section 2. The dollar crash and rupee surge. What happened to the rupee today? Now let's talk about currencies. The Indian rupee had its best day in almost 4 months. It jumped 75 paise to close at 88.06 rupees per dollar. During trading hours, it even touched 87.93, which was the strongest level we have seen in several days. Why did this happen? Two main reasons. First, because of what Powell said, the US dollar weakened globally. When the Fed cuts rates, holding dollars becomes less attractive because you earn less interest on dollar deposits. So investors sell dollars and buy other currencies. Today, the dollar index, which measures the dollar strength against other major currencies, fell by 0.20%. Second, crude oil prices crashed. Today, crude oil trading below $59 per barrel. It has fallen 9% in just 1 month. What is the effect of cheaper oil for India? This is massive for India. We import about 85% of our oil needs. When oil prices fall, our import bill goes down. Every $10 drop in crude oil prices saves India around $15 billion annually. Less money going out means less demand for dollars, which strengthens the rupee. A stronger rupee also means lower inflation. Think about it, when the rupee is weak, everything we import becomes expensive. Petrol, electronics, even medicines. But when the rupee strengthens, import costs fall. This gives the Reserve Bank of India, or RBI, more room to cut interest rates in December. And that's exactly what markets are betting on right now. A December rate cut is looking very likely. Section 3. What happened in global markets? How did other markets react? Today wasn't just about India. Markets across Asia rallied together. Japan's Nikkei index jumped 1.5%. Hong Kong's Hang Seng rose 1.8%. South Korea's Kospi surged 2.7%, which was its strongest session in months. Now here's what's interesting. Despite ongoing tensions between US and China, with tariff threats and sanctions flying around, Asian markets completely ignored the bad news. They focused only on one thing: the Fed is cutting rates, which means more money is coming. This tells us something important. Right now, investors believe that central bank policies matter more than trade war headlines. Money and liquidity are winning over fear. In Europe, markets also bounced back. The Stoxx 600 index rose 0.7%. France CAC 40 jumped 2%, mainly because luxury companies like LVMH reported strong sales. This shows that high-end consumers are still spending, both in Europe and India. What happened in India sector-wise? Back in India, not all sectors performed equally. Real estate stocks led the rally with a 3% gain. Why? Because investors are betting on December rate cut. When interest rates fall, home loans become cheaper and demand for property goes up. PSU bank stocks, which are public sector banks, also gained 1.67%. Again, the reason is the same, rate cut expectations. Financial stocks like Bajaj Finance and Bajaj Finserv jumped 3 to 4%. On the other hand, IT stocks like Infosys and Tech Mahindra fell despite reporting quarterly results. This is because investors are moving money from defensive sectors like IT and pharma into riskier, cyclical sectors like banking and real estate. This kind of rotation happens when market becomes optimistic about the future. Section 4. The foreign investor story. Who is buying and who is selling? Now let's talk about something very important. The battle between foreign and domestic investors. Foreign institutional investors or FIIs are big investment funds from outside India. On October 14th, they sold Indian stocks worth 1508 crore rupees. In fact, this entire month they have sold stocks worth 1961 crore rupees. Why are they selling? Three main reasons. First, they think Indian markets are expensive compared to other countries. Our price to earning ratios are higher. Second, there's uncertainty about US tariffs on India. President Trump has been threatening tariffs and foreign investors don't like uncertainty. Third, India has done very well in the last 3 years. Many foreign funds increased their India allocation too much. Now they are rebalancing by selling more positions. But here's the good news. Domestic institutional investors or DIIs, which include Indian mutual funds and insurance companies, are aggressively buying. On October 14th alone, they bought stocks worth 3,661 crore rupees. For the entire month so far, they have bought 17,791 crore rupees worth of stocks. What is the effect of this? This domestic buying is creating a floor under the market. Even though foreigners are selling, Indian markets are not crashing because our own investors are absorbing all the selling pressure. And here's the bigger point. If the dollar continues to weaken and the Fed keeps cutting rates, these same foreign investors might come rushing back to India in the fourth quarter of this year. That could be the trigger for a big year-end rally. Section 5. The crude oil advantage. Why is falling oil the biggest story for India? Let's circle back to crude oil because this is the most important development for India right now. Crude oil is at $58.76 per barrel. It has fallen 9% in 1 month. Now, as I mentioned earlier, India imports most of its oil. So falling oil prices directly impact three things. First, they reduce our import bill. Less money going out of the country. Second, they lower inflation. Fuel is a big component of inflation in India. Cheaper fuel means lower transport costs, which means lower prices for goods overall. Third, they improve something called the current account deficit or CAD. This is basically the difference between money coming into India and money going out. When oil is cheaper, this deficit shrinks. And all of these factors strengthen the rupee even more. Now combine this with the fact that India's retail inflation is already at an 8-year low, 1.54%. The RBI has minimum flexibility right now. A 25 basis points rate cut in December is almost guaranteed. What is the effect for you? If you are planning to take a home loan, car loan, or any kind of loan, rates could become cheaper in the next few months. This is also great news for businesses because lower interest rates means cheaper borrowing costs, which can boost investment and growth. Section 6. The real estate movement. What is happening in the housing market? One more important data point came out recently. September housing sales data showed something interesting. Overall sales volume were flat or slightly down. But here's the twist. Sales in the premium housing segment were up 14% by value. What does this tell us? Wealthy buyers are not stopping. Even with high prices and high interest rates, 10 to 15% of Indians are buying expensive properties. What is the effect if rates are cut? Now imagine what happens when the RBI cuts rates in December. Home loan EMIs will fall. Middle class buyers who have been sitting on the sidelines will suddenly find housing affordable again. This could trigger a massive boom in affordable housing. Real estate stocks have already started moving up in anticipation. This sector could be a star performer in the coming months if the rate cut actually happens. Closing. So to sum it all up, October 15th was not just a bounce. It was the day when multiple positive factors aligned at the same time. The Fed turned dovish, the dollar weakened, crude oil crashed, the rupee strengthened, and domestic investors kept buying aggressively. If this momentum continues, we could be looking at a strong year-end rally for Indian markets. Rate-sensitive sectors like real estate and banking could lead the way. But remember, volatility is still high. Markets remain nervous about trade tensions. So stay cautious but also stay aware of these big shifts happening beneath the surface.